Debt is generally considered to be bad. Totally understandable. I mean, it's one more thing to think about, and heaven knows how many are already keeping you up at night. But have you ever stopped to think? If debt is 100% bad, then why do the rich and affluent have lots of debts? Oh, you didn't know that they too have debts? Well, now you know. It might be confusing because they're already well off, so why borrow money? Basically, the difference is that they make good debts, the type that will not lead them to financial ruin. Good debts are well exemplified in the saying, "It takes money to make money." If you take on debts that help you generate income and build your net worth, then consider that helpful. That is what we're going to tackle in today's video. But before that, go ahead and click that like button. It helps bring more people into our little bubble. While you're at it, click the bell icon to subscribe to this channel and stay on the loop with the latest videos on personal finance and investments. Number 1. Take on product loans. It's not wise to loan money from the banks if you're new to business. It's only advisable to do when you're already years into your business and want to borrow money for improvements, expansions, and massive restocking. If you really want to start your own business but don't have the means to do it, you can take on product loans. The way product loans work is that you can have the products shipped to you without having to pay beforehand. This might sound too good to be true, but this has long been practiced by a huge number of businesses all over the world. Well, not all of them, because there are some products that would be too risky for such a setup. Most products usually come from China because it's loaded with factories that would be happy to let you sell their products for them. You can try products that never run out of demand, such as school supplies and daily essentials. The catch is that, though it sounds easy, it's not. You will have to gain their trust and prove that you have the capacity to give them back the money you owe them for the products. So, not only should you know how to sell products, you should also know how to sell yourself. Number 2. Debt refinancing. Refinancing, or refi, occurs when the terms of a loan are revised to obtain more favorable borrowing terms. Most rich people often choose real estate to take debts on because not only can they get tax deductions from it, they can also acquire properties and gain profit from it. Here's an example. Say you currently have $800,000 left on your $1 million mortgage for 30 years at 5%. Your monthly installment payments would be around $4,578. Your bank then informs you that you can refinance to a 3.5% loan for 30 years due to their decreased interest rates. Should you refinance, you will end up saving $702 monthly because your monthly installments will go down to around $3,876. Not only that, you can also rent out your property to other people, which means that you can get money from profits too. However, you should assess your situation properly. Ask yourself, should I refinance now? Is it more beneficial for me to refinance or just continue with my current terms? The key is to know if and when you should do it to avoid being at a disadvantage. Number 3. Short selling. You've heard about the stock market. You now do your best to foretell which companies are going to balloon and increase in value. Good! But did you know that a bearish market can be beneficial to you too? In such situations, you can sell short. What that means is you can borrow shares of a stock that you predict will decrease in value. Then, sell it before it goes down. Later, you can buy it for a lower price. Then, return the share you borrowed after you've made a profit. Not quite clear? Here's an example. Say you borrowed a share priced at $150 and sold it immediately. Since, based on your research and analysis, its price will go down next week. Now, you have $150 with you, but you still need to return the share you borrowed, so you wait to buy a share again. For you to make a profit, your prediction has to come true. If you turn out to be correct and its price dipped to $90 the following week, you can buy a share of that stock for $60 less than the value of the stock you owe. You will then return the share you borrowed. Then you will have gained $60 in profits. Neat, right? Don't get too excited though. It's not as easy as it sounds. This is a huge risk on your part because your hunch might be incorrect. And you will end up with a debt and a loss. Number 4, foreign exchange. You can make a lot of money by trading currencies when the prices rise and fall, just like you would in a stock market. Forex works just like the stock market. The only difference is that for every dollar you use in the exchange, you can borrow $100 more. That means you can get 100 to 1 leverage in this market. If you place yourself in the right position, you will enjoy huge profits even with just 1% increase. It's also worth noting that Forex is generally less volatile than the stock market. The only downside with this one is that it's only good for active traders. If you are a passive investor, you can't really make a lot. Want to know more about foreign exchange? Comment down below if you'd like a video about it, and click the bell icon so you'll be the first to know when the video's up. Number 5. Build a strong credit score. Earlier, I mentioned about getting bank loans only for improvements, expansions, and massive restocking. If you can prove that you are a reliable person and that your business can keep your money rolling, then the banks can lend you money for your plans. How do you prove that? Aside from collaterals, you can use your credit score. You can build it up by taking on smaller loans that you're sure you can closely follow and stay on top of. To assure proper funding and extensive options, having an excellent credit score, which would be upwards of 700, is ideal. Debt is tricky, but if you're disciplined and knowledgeable enough, then you can use it to your advantage. Carrying debt without a solid plan to honor it can lead to an unhealthy financial life. Also, keep in mind that you should avoid taking on too many debts. According to the Consumer Financial Protection Bureau, you should keep your debt-to-income ratio below 43%. Statistically speaking, you will be able to keep up with your monthly debt and mortgage payments when you stay within that zone. Another thing to keep in mind is to hit that like button if you learned anything from this video. Thanks for watching. Until the next video.